The check cleared 3 weeks ago. The renovations are done. The cabinets are in. The floors are refinished. The listing photos look incredible. You are already mentally spending the profit. Maybe a vacation, maybe a down payment on the next one. And somewhere between the granite countertops and the new pot lights, you made a single administrative assumption that is about to cost you $130,000. Not a fine, not a penalty on top of tax, the tax itself. Because the Canada Revenue Agency does not see a homeowner who flipped a house, it sees a builder, and builders collect HST. Welcome back to Canada Property Watch. In our previous investigations, we dissected the CRA's self-supply rule, the mechanism that forces landlords who build or substantially renovate a rental property to remit HST on the fair market value of that property the moment a tenant walks through the door, even if no sale ever happens. We exposed how thousands of investors triggered that rule without ever realizing the clock had started. Today, we are going deeper, because the self-supply rule is only the end of the story. The beginning, the part that most accountants skip right past in the initial consultation, is the CRA's builder test. The checklist that determines whether you are classified as a commercial builder under the Excise Tax Act in the first place. And if you pass that test, and you probably do, every renovation, every flip, every substantially improved property you have touched in the last several years becomes a GST/HST collection event. Not optional, not debatable, mathematical. Here's the number you need to carry through this entire video. Section 123 of the Excise Tax Act defines a builder in a way that most Canadians find genuinely shocking when they first read it. It does not require a construction license. It does not require a business registration. It does not require a single hammer swung for commercial purposes. Under the Act, you are a builder if you acquired an interest in land, including a residential property, in the course of a business or an adventure in the nature of trade. That phrase, adventure in the nature of trade, is where the CRA's forensic machinery begins its sweep. And it is where amateur investors fall directly into the trap because they spent the last decade believing that the principal residence exemption was a universal shield. It is not. The income tax principal residence exemption and the HST builder classification are two entirely separate legislative frameworks operating on completely different criteria. You can claim your property as a principal residence for income tax purposes and simultaneously be classified as a builder for HST purposes. Both can be true at the same time. That is the architecture of the trap. So how does the CRA determine whether your renovation or flip was an adventure in the nature of trade? There is no single test. What the CRA uses is a multifactor analysis drawn from decades of Tax Court of Canada decisions, and they apply it with algorithmic consistency. The factors are documented in CRA policy and they function exactly like a checklist. Each factor that points toward commercial intent adds weight, and the weight accumulates silently in a file you do not know exists until a reassessment letter arrives and the number on the front page makes your knees give out. Factor 1. The taxpayer's intention at the time of acquisition. This is the one people think they can control. They tell themselves, and sometimes their accountants, that they bought the property to live in it, or to rent it long term, or for their aging parents. But the CRA does not evaluate intention based on what you say. It evaluates intention based on what the evidence suggests. Your text messages, your emails to contractors asking about ARV, after repair value, your conversations with real estate agents about comparable sales, your financing structure, specifically whether you use short-term, high-ratio financing inconsistent with someone who planned to hold the property for decades. Your search history, if it ever becomes relevant in an audit. The CRA has been granted extraordinary access to third-party data, including financial institution records and real estate transaction data pooled through the Canada Revenue Agency's Real Estate Audit Initiative. They are not guessing at your intention. They are constructing it from evidence you left everywhere. Factor 2. The nature of the asset. The CRA gives weight to whether the property type is the kind of asset that is typically held for personal use or typically flipped, a single-family home in a suburb you do not live in. were purchased at the height of the market, gutted, renovated, and relisted within 18 months, reads as a commercial transaction regardless of what you intended. The tax court has consistently found that the nature of the asset is not determinative on its own, but when combined with other factors, it reinforces the commercial character of the transaction in a way that is very difficult to dislodge. Factor 3. The extent and nature of the taxpayer's activities in relation to the property. This is the factor that destroys people who DIY their way through a renovation. Every permit pulled, every contractor hired, every material purchased, every design decision made. These activities are consistent with someone operating in the business of improving property for resale. The CRA does not require that you be a licensed contractor. It requires only that your level of involvement goes beyond what a simple, passive homeowner would do. If you project managed a kitchen renovation, a bathroom gut, new flooring, new electrical, and a landscaping overhaul, you were not behaving like a homeowner improving their primary residence. You were behaving like a developer, and the CRA will treat you accordingly. Factor 4. The taxpayer's course of conduct and prior transactions. This is the factor that retroactively weaponizes your entire history. If you have bought, renovated, and sold more than one property in the last several years, each transaction becomes evidence of a pattern. The CRA calls it a course of conduct, and once they identify it, they can reassess multiple properties in a single audit cycle, not just the most recent one. All of them. Every flip that you treated as a tax-free principal residence claim. Every renovation that you expensed against rental income while quietly planning to sell. The forensic audit does not begin and end with the transaction that triggered it. It opens a window into everything that preceded it. Stay with me, because what comes next is the legal mechanism that makes the builder test genuinely catastrophic, and most people never see it until it is too late. Once the CRA determines you meet the builder definition under the Excise Tax Act, the obligation to collect and remit HST on the sale of the property does not arise from your intent to collect it. It arises from the act itself. Builders are deemed to have collected HST. It is not optional. It is not something you can retroactively elect out of. But if you sold a property that the CRA classifies as having been substantially renovated, and the threshold for substantial renovation is 90% of the interior of the existing building, excluding certain structural elements, then you were legally required to collect HST from the buyer and remit it to the CRA. If you did not, the CRA will assess you for the full amount as though you had. That means they calculate the HST on the final sale price as if you had built that property from the ground up, add applicable interest going back to the date of the transaction, and deliver a notice of assessment that feels less like a government letter and more like a precision strike on your net worth. Here is the arithmetic that breaks people. A property sold in 2022 for $900,000 in the Greater Toronto area. Assuming the property qualifies as a newly constructed or substantially renovated residential complex, the HST payable on that transaction in Ontario is 13%. 13% of $900,000 is $117,000. Add arrears interest accruing daily at the CRA's prescribed rate since the date of closing, and add any applicable penalties for failure to register as an HST registrant, and you are looking at a reassessment in the range of $130,000 to $140,000 on a transaction you already closed, already spent the proceeds from, and already filed as a tax-free principal residence disposition. The new home buyer, the person who purchased that property from you, may also be exposed. Because if you were a builder and the transaction was taxable, the buyer was entitled to a new housing rebate, but the buyer can only claim that rebate if the HST was properly disclosed and collected in the sale. If you sold the property and the agreement of purchase and sale was structured as HST included in the price, or worse, if HST was never mentioned at all, the CRA may pursue both parties. The buyer did not receive the rebate they were entitled to. You did not remit the HST you were obligated to collect. Two people. One transaction. Two separate legal exposures. This is not theoretical. CRA real estate audit teams have been actively processing exactly these cases since 2021, with a significant escalation in reassessment volume beginning in 2023. Now, here is what the builder test looks like when applied to someone who did not even sell, someone who renovated a property and converted it to a rental. This is where the self-supply rule connects directly to the builder framework and where the financial execution becomes total. If you are classified as a builder because you acquired and substantially renovated a residential property in the course of an adventure in the nature of trade, and instead of selling the property you moved in or converted it to a rental, the Excise Tax Act deems you to have made and received a taxable supply of that property to yourself at fair market value on the day you first occupied it or first rented it. The HST owing is calculated on the full fair market value of the property at that moment. You owe the government HST on a property you never sold by on proceeds you never received in a transaction that never happened except in the legal fiction created by the Excise Tax Act. You are required to cut a check to the CRA for a percentage of the market value of an asset you still own and are still living in or renting out. For a property that was worth $800,000 at the time of first occupancy or tenancy, the deemed self-supply means an HST liability in Ontario of $104,000, due and payable. The only partial relief available is the new residential rental property rebate, which offsets a portion of the federal component of HST for landlords who genuinely intend to hold the property as long-term rental accommodation. But that rebate has its own eligibility criteria, its own application deadlines, and its own documentation requirements. And miss the deadline, which is 2 years from the date of the triggering event, and the rebate is gone. The full liability remains. Drop a comment right now. Have you ever pulled permits on a renovation property? Just type yes or no. Your answer will shape the next part of this investigation. The CRA's enforcement architecture for these cases is not passive. Since the launch of the Real Estate Tax Center and the subsequent integration of provincial land registry data, title transfer records, permit data, and financial institution mortgage discharge information, the CRA has been cross-referencing transactions at scale. The algorithm flags patterns, multiple properties, short hold periods, renovation permits followed by title transfers within 24 months. Now, rental income reported on T1 returns for properties that subsequently sold at significant gains without HST disclosure. Every one of these data points is a trigger, and once a file is flagged, a human auditor reviews it and makes a determination about whether the builder test criteria are satisfied. The auditor does not call you, they do not warn you. They issue a requirements to provide information, a legal demand under the Income Tax Act or the Excise Tax Act, requiring you to produce records going back up to 7 years in cases involving potential misrepresentation or fraud, your contractor invoices, your bank statements showing material purchases, your communications with real estate agents. If you cannot produce these records, the CRA estimates, and when the CRA estimates in a real estate audit context, they do not estimate conservatively. The people most exposed by the builder test are not professional developers. Professional developers know the rules. They have GST/HST registrations. They collect and remit. They claim input tax credits on the materials and labor they purchase, which offsets a significant portion of their ultimate liability. The people most exposed are the amateur investors. The teacher who renovated 3 condos between 2019 and 2022. The small business owner who bought a semi-detached in Hamilton and listed it on Airbnb for 18 months before selling. The couple who claimed every property they ever touched as a principal residence and told their accountant to just run the numbers. These are the people sitting on unreported HST liabilities they do not know they have. And the statute of limitations does not protect them the way they think it does. The standard reassessment period under the Excise Tax Act is 4 years from the date a return was required to be filed. But there is no limitation period at all where the CRA can demonstrate misrepresentation attributable to neglect, carelessness, or willful default. And failing to register as a builder, failing to collect HST on a taxable sale, and failing to self-assess on a deemed self-supply are precisely the kinds of omissions the CRA characterizes as careless or negligent. The file stays open indefinitely. The professional consequences extend beyond the financial. CRA audits of this type are frequently referred to the proceeds of crime reporting framework when the amounts involved are significant and the pattern of behavior suggests deliberate concealment. A referral does not automatically mean criminal charges, but it does mean the file is reviewed by the CRA's Criminal Investigations Division, and it means that the property transactions in question are placed under a higher level of scrutiny. Financial institutions are notified of potential proceeds of crime concerns. Mortgage applications become complicated. Refinancing becomes complicated. The person who thought they were simply not reporting a flip correctly suddenly finds themselves in a framework designed to pursue people who launder money through real estate. What about the buyer who purchased the renovated property and is now living in it? They thought they bought a house. What they may have inadvertently purchased was the downstream exposure of a builder transaction that was never properly structured. If the seller's HST liability is assessed and the seller cannot pay because they already spent the proceeds, because they are over-leveraged on other properties, because the money is simply gone, the CRA has tools to pursue third parties who benefited from the transaction. A Section 325 assessment under the Excise Tax Act allows the CRA to assess a transferee, the person who received property from a tax debtor, for the lesser of the tax debtor's net tax liability and the FMV of the property transferred. In a marital transfer, an interspousal property transfer, or even in certain arm's-length transactions where the consideration was below fair market value, Section 325 can reach the new owner. This is not a commonly understood provision, but it is a real one, and it operates with the same mechanical indifference as every other provision in the Excise Tax Act. Let us be precise about what constitutes a substantial renovation for the purposes of the builder test, because this threshold is where people convince themselves they are safe. The CRA's position is that a substantial renovation means the renovation of the whole or substantially the whole of the interior of a residential complex, to the extent that the building is essentially a newly constructed building when the renovation is complete. The 90% threshold is administrative guidance, not a hard statutory number. What matters is the functional question. Does the renovated building look and function like a new building from the interior? New kitchen, new bathrooms, new flooring throughout, new electrical panel, new HVAC, new insulation behind open walls. If the answer is yes, if a reasonable person walking through the finished renovation would describe it as essentially a new build inside an old shell, the substantial renovation threshold is likely met. The builder classification follows, the HST obligation follows, and the clock started running the moment you first occupied or first rented the property. A /B vote. Type A, if you want us to go deeper on the HST new housing rebate and how to actually use it before the deadline expires. Or type B, if you want us to map out exactly how CRA cross-references permit data with title transfers to flag builders who never registered. Your vote decides what we expose next. The only complete defense against the builder classification is documentation of genuine personal use intention at the time of acquisition, supported by evidence that is inconsistent with commercial intent. That means a personal move-in documented with hydro accounts, mail redirection, driver's license address changes, health card registration updates, children's school enrollment records if applicable, and financial records showing the property was used as a primary residence and not managed as an income-producing asset. It means financing structures consistent with long-term owner occupancy. It means a hold period that reflects genuine residential use rather than market timing. And it means not having done this before with other properties in a pattern that the CRA can reconstruct as a course of conduct. The trap is not the law itself. The law is clear. The trap is the gap between what amateur investors believed was permissible and what the Excise Tax Act actually requires. That gap was enormous during the 2017 to 2022 housing boom, when renovation flips were generating $200,000 and $300,000 profits, and the social consensus was that principal residence exemptions protected everything. They did not. The HST framework operated independently, and it continues to operate independently today. The reassessments being issued now are not for transactions happening today. They are for transactions that happened 4 and 5 years ago, transactions where the money has been spent, where the investor has moved on to the next property, where the accountant filed a T1 and called it done. The bill is arriving now, and it is not arriving with a phone call or an email. It is arriving by registered mail, in an envelope with the Canada Revenue Agency letterhead, addressed to someone who is about to have a very specific and very permanent conversation with their financial reality. The Notice of Assessment for Unremitted HST does not negotiate. It does not offer payment plans at the outset. It demands full remittance within 30 days, and if that remittance does not arrive, it triggers a cascade: collections activity, potential jeopardy orders, securing the CRA's claim against any real property still held by the taxpayer, and wage garnishment executed directly against employment, income, or business receivables. This is the builder test, not a quiz, not a bureaucratic formality. A legal classification system that has been quietly processing the transactions of an entire generation of amateur investors and is now beginning to produce results. The reassessments are real, the amounts are real, the enforcement mechanisms are real, and the people receiving these letters had no idea they were in the crosshairs, because no one told them that finishing a basement, flipping a semi, or renting out a substantially renovated property made them, in the eyes of the Excise Tax Act, a builder. Canada Property Watch does not tell you this to scare you without purpose. We tell you this because the information asymmetry between the CRA and the average property investor is not an accident. It is a structural feature of a tax system that relies on voluntary compliance and then moves decisively when that compliance does not materialize. The builder test has existed in the Excise Tax Act since the early 1990s. It is not new. What is new is the enforcement capacity, the data integration, the algorithmic flagging, the dedicated real estate audit teams. That makes it functionally terrifying in a way it never was before. If you have renovated and sold, or renovated and rented, a property in the last 7 years, and you have not had a conversation with a tax lawyer, not a real estate agent, not a mortgage broker, not a general accountant, but just a tax lawyer with specific GST/HST experience, you have not completed your risk assessment. That conversation is the only thing standing between you and the registered envelope. We will be here when it arrives. Subscribe and hit the bell. Because next week we are pulling the curtain back on something that connects directly to what we exposed today: the CRA's input tax credit clawback mechanism, and how builders who did register and did claim ITCs are now being audited for the same transactions from the opposite direction. You registered, you claimed, and now they want it back, with interest.